So let's just show people a couple of brief data points here on the portfolio you were talking about. If we just go back, our producer could show us some slides here. That's just quarterly performance. On to the next here. Just want to show people, this is basically, the OUSA performance compared to its benchmark value. And once in a while, value has a fantastic period. Q1 of 2021, for example, the gray bar shows value had a big pop after lagging for so long. But then what actually happens is OUSA, just steady Eddie, catches up to and passes value. And that's kind of what that lower chart shows. After being behind value at the beginning of the year, it made up about 10% outperformance versus value by the end of last year. Skip to the next slide. You're just going to see the once in a while occurrences of these periods when OUSA will lag value briefly during the gray period and then outperform during much, much longer subsequent periods. So that's what's depicted there on the left slide. And the right slide, just using OUSA versus high dividend. One quick thing about high dividends are stocks like Kmart and GE and so on that were once upon a time high dividend stocks. I don't need to say any more about what those stocks became afterwards. So chasing the highest dividends, not at all the OUSA strategy. It's the quality stocks. See that on the next slide here. Quality means, Kevin was talking about it. What it means is high profitability. So 13.9 for the OUSA index compared to 6 and a bit for value. Dividend growth, much higher. Leverage, lower, etc. So metrics that you would actually probably prefer to own than the generic metrics. Skipping to small caps, Kevin talked about that. It's the same strategy but applied to the small cap, mid cap space, much higher profitability, over 10% compared to under 3% for generic small cap value. And so that generates for investors a lower volatility way of owning small cap, mid cap stocks for the long term rather than viewing it as a temporary trade. And by owning long term, you get some diversification, you get more US centric companies. And so it's great diversification in our view. Quick bit about Europe, Kevin. It was actually on, we'll skip the next slide while I'm talking about it. It was on that colorful bingo board that we started with as one of the themes for the year forecast by the people that put that together. This here shows our Europe OEUR ETF and its performance in the black bars, basically from the period of the beginning of this year through now, outperforming Europe value. And one of the really important things, and Kevin, you mentioned this on CNBC, and I think it kind of attracted some positive attention. OEUR is a way of owning Europe, the top 50 global multinational companies that are in Europe without owning European banks. Give us a quick comment on European banks without taking too much risk of insulting anybody who's on the call here that happens to be related to one. What are your thoughts on investing in European banks?
I wouldn't invest in them. One of the challenges that the entire banking industry's had is the long-term effects of basically negative interest rates, or in the case of Europe, zero to negative interest rates, has had a devastating effect on return on assets. And so these banks are living dead. And they are probably the worst sector of the European economy. Highly regulated, no return on assets, a miserable existence. You need them for financial services, but there's just nothing to make you think that their predicament's going to change. And so, if I'm going to invest in Europe, I want to make sure I own none of them because they are just a lead weight on any portfolio. And indeed, OEUR excises them, removes them, and but I don't know how to say it any nicer. In terms of a portfolio, European banks are radioactive waste.
However, in OUR, you end up with Europe's biggest tech stocks, consumer discretionary, consumer staples, healthcare, and there are a lot of really, really interesting global companies in those categories that happen to have headquarters in Europe. Let's skip to our last little topic before we get to just closing out a fun topic here. So this topic here just shows you the valuation discount of the stocks in the OGIG index relative to the NASDAQ 100 index. And so you got a long-term trading history, we call it long-term, since 2018, and that ratio, you see the upper band. And then what happened about, call it 12 months ago, is the OGIG stocks got, relatively speaking, cheaper than the NASDAQ stocks compared to history. Meanwhile, skip to the next slide, you'll see that the revenue growth in this next slide shows how stronger revenue growth has been in the OGIG stocks. Number one weighting by category, enterprise software, it's cloud, cybersecurity, etc. 42% of the OGIG portfolio, 50% trailing revenue growth, 28% forward revenue growth this year, next year. That's really important. That's what Kevin touched on in terms of quality tech stocks. There's tech stocks that actually have revenue growth as well as great balance sheets.